Hello, 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 and welcome back to another episode of Beyond the Code. Today we have a really fun episode, especially for you newbies out there and you normies. We're going to go to the roots and discuss with Nadav Ellinson, who is a financial planner and the CEO and co-founder of Black and White Finance. Nothing, I should say, in this episode or in any episode ever is financial advice, legal advice. Everybody should do their own research, but there's going to be a lot of really fun, interesting, and engaging discussions here. We're going to talk a little bit about dollar cost averaging versus bulk investing. We're going to talk a little bit about buying Bitcoin ETFs versus holding your own Bitcoin. And we're going to talk a little bit about why you should or shouldn't buy crypto, maybe touch on a few apocalyptic scenarios, and just generally have a really good time, as we always do. So thank you for tuning in and enjoy this episode. Welcome to Beyond the Code, the podcast where industry experts and brilliant legal minds discuss the impact of new emerging technologies. I'm your host, Yitzy Hammer, a lawyer and tech enthusiast. Join us as we explore the legal, regulatory, and ethical issues surrounding AI, blockchain, and more. Get ready to go beyond the code and stay ahead of the game. Nadav Ellinson, welcome to Beyond the Code. It's an absolute pleasure to have you here. For me personally, I'm like a little bit fanboying right now. I very, very much enjoy your content on LinkedIn and other platforms. I had the opportunity, full disclosure, to do a bunch of sessions with you together with my wife just to get an idea as far as our personal financial planning is concerned, which helps me to understand how expert you are at simplifying complex financial topics. All throughout our sessions, you were kind of skeptical as to my approach to crypto investing, which is kind of what spurred me to put you on the spot and say, let's talk about crypto investments and how much they could or should consume from one's investment portfolio. I'll just take a step back and introduce you briefly. So Nadav was a co-founder in an early stage AI startup called Intelligo, which I had the opportunity to work with him very briefly on. In addition to running a nonprofit called Magalei Nefesh, which maybe he'll talk about a little bit later, he runs together with his partner Aaron. How do I pronounce his last name? Blue and White Finance, which advises Olim on how to plan their finances smartly. This is also probably a good opportunity to plug in a disclaimer and say anything we discuss on this podcast is not and never should be considered legal or financial advice. Do your own research always. Without further ado, Nadav Ellinson, welcome, and I'll pass the mic over to you.
Thank you, Yitzy. It's a pleasure to be here, and I really appreciate the invitation. Having worked together, as you mentioned, for a number of months, looking at your own personal finances and understanding the work that you do in the crypto space, and being able to talk about kind of the interaction between crypto and investment and financial planning is exciting. So it's good to be here.
Fantastic. So first question would be, assuming that everybody should kind of diversify their investment portfolio, assuming that they have one, what portion in your mind would you say what would be the range that you would view as being responsible for one to allocate to crypto investments?
Yeah, it's a hard question. Firstly, because crypto, even though it's been around for a number of years and been popular for still a number of years, there isn't a lot of data on long history of what kind of returns we can expect and how the risk is going to play out over time. And so it makes it tricky. And people are just trying to navigate this question now. There are some financial planners that are starting to say that crypto does have a place, Bitcoin specifically, in a diversified long-term investment portfolio. And you hear others talking about something in the region of 5%. But I think we have to start by, number one, going back to have a look at what our goals are in a portfolio, and then also think about what kind of risk we ascribe to crypto or to Bitcoin specifically, if that's what we want to start by looking at. And here, at least what I think about when we look at core goals for a long-term portfolio, is a family that's working hard, that's able to put aside a certain amount of money, and that ultimately wants to use that money to be able to retire or to be able to give to their kids to help them out, or to be able to pay for life events in the future. And when we're looking at those kind of goals, we want to make sure that we steer clear of anything that is too speculative or too much that touches on gambling over the
I'm cringing here when you when you're using these terms like gambling. But yes, okay, I'll let you run with it.
Yep. And so maybe we can start by having a chat about, and I'd love to hear your thoughts as well on what kind of risk we ascribe to crypto and the crypto space.
Okay, that's a valid point. Throwing the ball back in my court. So first, I mean, like, what is crypto? When we talk about investing in crypto, what does that even mean? And for like the newbie or the normie who's first hearing about these concepts or has heard about them or read about them in the newspaper, but then immediately discounted it because it seemed too complex for them. What is crypto and what does it mean? Number one, you have within the world of crypto, I guess, only two types of coins. You have Bitcoin, okay, which was like the first cryptocurrency. It was first launched in January 3rd, 2009. And then you have what everybody calls either alts or shitcoins, depending on who you're asking, and they kind of like move in tandem with Bitcoin. In a sense, it's not very different from like the S&P 500 and the rest of the market, but I don't want to go there yet. Bitcoin itself is it's a finite token. Okay, there will only ever be 21 million Bitcoins, of which like 19.5 million have currently been mined. Okay, when I talk about mining, I mean people who contribute computer power in order to solve complex mathematical equations that allow the facilitation of transactions on the Bitcoin blockchain, thereby creating new tokens. Okay, I know that sounds complicated, but basically that's how it works. One of the main attributes of Bitcoin and other cryptocurrencies is that they're decentralized. Basically, rather than sitting on a server somewhere, they're spread over multiple nodes, and it makes these blockchains more robust and more secure and more complex in many senses. Bitcoin as the first is actually kind of a clunky, a slow and expensive chain. That being said, it's viewed, I guess, because of its legacy position, as kind of like the gold of cryptocurrency. It's often used as a store of value, or viewed as a store of value. I can understand for somebody who's speculative about these type of assets saying like, what do you mean? How could it be a store of value? Gold I could wear, as a ring or as a necklace, but Bitcoin, what is it? It's just air, right? But it's a lot more than that. Again, I talked about the computer power that's required to power it. Like it actually is representative of electricity and energy assets that add additional value to it, quantitative value. There are other more complex features as well. And I don't want to bore you too much because I know that probably most of the people who are listening to this episode in particular are new to these ideas, and this is probably getting already a little bit too complex.
So let's start from Bitcoin, because we can look at altcoins separately, and I think there's obviously a lot more risk involved in altcoins. But usually when people are talking about building a fundamental crypto portfolio, something that might sit in their long-term account potentially for 10, 20, or 30 years, they're often talking about Bitcoin. I personally think there are some serious long-term risks when it comes to Bitcoin sitting in a long-term portfolio. I can maybe start talking through some of them, but I always find it interesting to ask people from the crypto community whether they feel like there are significant long-term risks to Bitcoin itself. How do you feel about Bitcoin in the context of making up a serious part, maybe 20%, of a long-term portfolio, for whether you're talking about yourself or whether you're talking about someone else that you would advise?
Well, I find it interesting that you push back so heavily. One of the things that you talk about in your courses is diversification across jurisdictions or across geographical regions, right? Being exposed to multiple geographical markets and asset classes. And I just see this as exposure to another asset class, not only to another asset class, but also exposure to the extent that financial markets shift to a great extent towards like decentralized finance. Like this is one way to be very, very exposed to that, rather than going and acquiring shares in Coinbase or other publicly traded crypto companies.
Yeah. So
Also,
I think
I mean, we don't have the same track record that the S&P has, but if you look at Bitcoin, which is a very, very volatile asset, since its launch in 2009, it has consistently gone up year over year.
Right. I think one distinction that's valuable to start from is the difference between intrinsic value and market value. When we have a look at investing in a company, so I become a shareholder of a company, let's say the company is producing $1 million of profit, of earnings in a year, I'll come along and say, I'm willing to pay $5 million for that company, because then I'll own those future profits. And I also have the opportunity to grow the company and take advantage of its assets. And regardless of what the market thinks about that company, even if there's some big scandal and the price drops dramatically, at the end of the day, they're producing $1 million of assets. And that gives it an intrinsic value. That is, it gives some fundamental worth that's separate from what the market believes and can be differentiated from supply and demand. Well, in this case, mostly demand, because at least with Bitcoin, supply is getting towards fixed. And that provides confidence in the ability for the asset to maintain a value over time. Now, if I'm investing in one individual company, obviously the company can go to zero. But when I'm able to diversify across real companies that are each producing assets, that are each producing profit and value for society, and I'm investing in an index fund which adjusts its holdings to always keep up with the companies that are leading in the market, I can be very confident that in 50 years' time, I'm going to be holding an asset that will have real value and that will have grown significantly from where it is right now, regardless of how demand flows and what the market believes.
Mm-hmm.
The challenge with a speculative asset, and Bitcoin by definition is a speculative asset because its price is only controlled by the demand in the market. When you look at any supply-demand equation, when you fix supply, then demand is the only thing that will make the price go up and down. Its price is dependent on demand continuing. And main question that I ask myself with regards to Bitcoin is, how much confidence do I have that in 50 years the demand will still be there? And I think the biggest risk that exists with regards to something like Bitcoin is that something else comes along that people prefer for whatever reason, whether it's because it's got wonderful utility, and I think utility is only a small part to play in kind of Bitcoin price determination, or it's just hot. It's more exciting in terms of speculation. And I can imagine a scenario where the crypto community that has so much belief in Bitcoin going to the moon and says that they'll hodl no matter what. Moving off to something else that comes along. I don't know what that might be. We can call it wow coin. But to think that Bitcoin is going to be the thing that is going to exist as the leading store of digital value for the next 50 or 100 years, I think is just a guessing game. And there are other risks that I think exist, but if I was to summarize the main one, in my mind, that's it.
Okay, I don't wholly disagree with you. Okay, I want to make one thing clear. It's not like it's me for crypto, you against crypto. Like, there are definitely a lot of, even though my entire livelihood is invested in the crypto industry, I'm not a Bitcoin maxi, and I have a lot of questions myself about Bitcoin that don't make sense to me. What you said, that something else that people like better will come along. Literally everything that's come along since Bitcoin has been better than Bitcoin, right? Every altcoin, every layer 2 and every other layer 1 that's been launched since Bitcoin has been better than Bitcoin in some way. One is faster and one has more utility
and transaction.
Yeah, and if you look at like Ethereum, actually, I just published an episode with somebody from the Ethereum Foundation who is talking about some of the amazing things that the Ethereum Foundation is working on. Ethereum, from like a price performance perspective, has just like performed horribly, like and continues to perform horribly. Like, anytime Bitcoin goes up, Ethereum's either stagnant or going down. Like, doesn't make any sense to me. So I'm definitely not like qualified to tell you what makes these things move or not move. But I could say that everybody's going to leave Bitcoin and go to something cooler and faster. Like, I don't see that happening, because everything is cooler and faster. And yet Bitcoin still is like the mothership. Maybe it's because people like Michael Saylor and now the Trump family are throwing so much money at it that like it's too big to fail. I don't know. Or maybe it's just because of like the legacy position that it has within the crypto ecosystem, but it's not going anywhere. except up, probably.
All of those things that you say are true. When I say that people will move to something else, I don't think the utility here or the quality of the underlying technology is the determining factor. The same way that I don't think that the utility or the quality of the underlying technology is the determining factor in the price determination now or into the future of any of these, because I think that speculation is the main driving force. And Bitcoin was able, as kind of the first mover, to establish a position as something that is the most stable and long lasting to date. But I think that we've only had, 10 plus years of seeing that kind of process play out.
Yeah, but what
And
a crazy 10 plus years it's been. I mean, like,
100%.
has any other asset performed that way?
No, this is unique. The crypto world is unique in creating something that never existed before, at least in my knowledge. But I also think that with all new technologies, they only last for a certain period of time. And I think that's true of
They evolve. Like
some technologies.
I used to always tell people, like, I'm not bullish on Bitcoin necessarily. I'm bullish on blockchain from a technology perspective. Like, there's been so much innovation that's come out here that it can't be totally overseen. Like, eventually the traditional finance will have to implement at least some of the features of blockchain technology.
Sure. I mean, I think blockchain is a great technology. Whether or not and how quickly it'll be implemented into traditional finance, I don't know. But I think that has no bearing on how much Bitcoin we should put in our portfolio. And
Okay.
which is, I guess what we're trying to determine in the current conversation. And I think that when we look at any technology that we think is a Google search, right, hugely like used by everybody in the world, but just over the last year or two, we're seeing AI search and the like. We're starting to realize that something that we thought could never be replaced perhaps can. And I think that with all speculative assets, and we can look through history at a number of them, at some point in time, the demand goes elsewhere. I think that is likely to happen at some point with Bitcoin. It doesn't mean that the person that's investing today won't see it go up to $100,000. Maybe that'll happen. Sorry, is that 100,000 to
A million.
10 or 100 times that? But I think at some point the demand will evaporate. And the question we have to ask ourselves with any assets is, when I see the price going down, how do I react? And if we go back to traditional, diversified investing for a moment, we see crashes every 20, 30 years. And I always say to clients and to students of our investing course that you only win with stocks if you can stick to your strategy and stay invested. And the only reason why people can have the confidence to be able to do that is because they can learn about the intrinsic value of these companies, and that at the end of the day, will recover because of what's actually happening behind the scenes. And the question is, if, let's say I convinced you that one day Bitcoin may no longer exist, when we start seeing it crash from, let's say, $1 million down to $50,000, at which point do we bail out? And I think that is a scary part of having a speculative asset as a core part of a long-term family's portfolio.
And when you say core, you mean like what in your mind is like way too much exposure? Like you said 5%. I think that's, in my mind, that's very, very low. But maybe, there's a long way between 5 and 30.
There is. At the end of the day, I think a family has to ask, how much can it afford to lose? And how much, and what the purpose of their savings is. And so if, let's say, a family that doesn't have a huge amount of assets and they're trying to build up a retirement portfolio, or they're scraping together every dollar or shekel to be able to save up for a house, I think putting 20% in any kind of asset that has excess risk beyond what research is able to tell us has some degree of stability is
risky.
risky. And I say that to clients who are keen on investing in stocks but choosing individual stocks. I say that to clients who are interested in trading, in buying and selling based on their own perception of companies. And I think even more so with Bitcoin. I'll traditionally tell people that up to 10% in in some kind of investment that has that, not throwing away money and really gambling, but putting 10% in an investment that excites them and that's able to keep them connected to to finance, I don't have any problem with. And if someone comes along and says, I want to have 10% in Bitcoin, I don't think that's horrible, because to kind of go on the opposite track, I think the probability of Bitcoin going to zero in the next 10 years is probably low. By the way, there are other very well-renowned investment professionals, putting aside Warren Buffett and others who are really not Bitcoin believers. But you take someone like Eugene Farmer, who is considered to be the father of index investing and the
Mm-hmm.
like. I just heard him on a podcast that was actually recorded in the last few weeks. He very much believes that Bitcoin is going to zero in the next 10 years. And I could see it happening, but I think the risk is relatively low. Once you go beyond 10%, then I think you're starting to put more significant portions of your assets at risk. And at the end of the day, though, I have no science that backs up that number.
Okay. So you think between 5 to 10% is fair and reasonable.
And
So
that also, I mean, we started by saying that those financial planners and investment professionals that are starting, and there aren't a huge amount of them, but those that are starting to recommend allocating portions to Bitcoin are at around the 5% from what I've been seeing.
okay. And when we say 5 to 10%, you're talking about an entire crypto portfolio, not just Bitcoin per se.
Yeah.
Okay. So let's assume you have 5 to 10% that you put aside for a dedicated crypto portfolio. We could talk after about what that looks like. If you ask me, again, not financial advice or anything, but like a little bit of Bitcoin, a little bit of Ethereum, Solana, and then maybe 10% of your 10% to just play around with like Trump coin and other shit coins just for the fun of it, because like it's in the end of the day it's really fun. Like
Yeah.
it
I
is
mean,
the
and
most
by the way,
lively.
I didn't say this in the beginning, but back in, I think it was around 2017 with the ICO craze, I took $2,000 and had a lot of fun with it, and lost money on ICOs and learned a lot about the space. And I think that was very fundamental to really just understanding a little bit about what
Just
we're talking
learning,
about.
yeah, absolutely. So I highly encourage that. Just learning, but coming in with like a very beginner's mind and saying like it's very possible that I'll walk out with nothing.
And also realizing this is often a mistake people make when they get involved in very volatile assets, that one of the worst things that can happen to you is to have a huge amount of success upfront.
And you're like,
And
this is it, man. And then you go
yeah,
from 5, 10% to 40, 50% because you think that whatever you did the first time you could just replicate, but it's never the same.
exactly. And that's also very true with stock trading and anything else, where the research shows that the large majority of people lose money. But if you happen to have had some luck, then you'll think otherwise.
Okay, so let's assume that you have that whatever 5 to 10%. Um, diversify it across various crypto assets. And there's two other questions that I want to talk about. I guess the first one probably is something that I'll speak about a little bit more. But basically, the other day I was talking to my accountant, and he's like, I see all this crypto stuff. It seems like you're doing really well. I want in. And I was telling you, okay, buy some Bitcoin. You gotta download a wallet. You have they have the 12 or 24 word seed phrase that you have to store somewhere, and you might lose it, and then you have to get from an exchange. And after you get the exchange, you have to buy it somewhere. Anyways, for somebody who's coming into this industry, it's enough to deter them not to buy. He's like, you know what? I'm just gonna buy in a Bitcoin ETF, which you can do now. Okay, there are various Bitcoin ETFs, including BlackRock's, and in a short time, I think we're gonna see ETFs for Solana and Ethereum as well. So, and he was very happy. 2 weeks later, he called me and he's like, "Wow, this thing went up like 20%." Like again, people often ask, what is the difference? Like, why should I buy actual Bitcoin versus buying an ETF? And I don't know if this is something, Nadav, that you feel comfortable speaking about, but
Yeah, I
like,
can a little bit.
what's that?
Yeah, for sure. I can speak a little bit about it.
Yeah, sure.
I think the only reason, I mean, if we're looking at the coins that actually have ETFs and that are easy to buy on a public stock exchange, I think the only reason to buy directly is if you're particularly concerned about the decentralization piece and the ownership piece. And so, I mean, I guess just explain a bit. If you buy Bitcoin directly, then you have the key, and essentially If we put it in physical terms, you own the Bitcoin, it's sitting in your house. If you're sticking it on a cold wallet, and people that feel that that is the right way are usually doing it because they're worried about the traditional finance systems, about systems collapsing, about government being able to claim assets. And so I think that there's obviously a lot of value in being able to do that yourself. But for the average person that perhaps isn't so concerned about those things, but wants to have an element of cryptocurrency or Bitcoin specifically in their portfolio, doing it that way has a lot of risks and is very difficult technically. So you may have heard lots of stories about people that lose their private key or that lose their seed phrase, the passphrase, and then aren't able to access the Bitcoin. So maybe you've got this physical wallet sitting in your drawer, but it's just a brick, and the money's lost. And there's been huge amounts of Bitcoin and other cryptocurrencies that have been lost that way. And for the average person that isn't on top of this all the time, I think there's a real risk of that happening. There's also a lot of technical things that you have to learn. You have to sign up for accounts, and you have to learn how to handle the phrases and the wallets and everything else. So for the average person, you can now buy an ETF of Bitcoin. There's also some Ethereum ETFs, I think, that have come out in some jurisdictions. You can correct me if I'm wrong. And what's actually happening is there's another party, let's take BlackRock, for example, that they themselves are doing all the hard work. They're buying and they are listing a fund on a stock exchange that you can buy and whose price exactly tracks or almost exactly tracks the price of Bitcoin itself. And for anybody that has any experience buying an ETF or trading a share, it looks exactly the same to buy an ETF of Bitcoin, and it's very simple and straightforward.
So there's a saying in crypto, not your keys, not your cash, right? Like if you don't have the private key, then it's not yours. A lot of people come to the crypto ecosystem for libertarian reasons, anti-establishment. And one of the beautiful things about Bitcoin decentralization is like there's no middleman. Like when you have crypto in your wallet, it's a wonderful feeling. Okay? I could see it, I could send it to somebody else, and there's virtually no regulatory oversight on most aspects of it, and no middleman, and nobody who's gonna charge you who's gonna renew your management fees every month or every year. Um, and it's your keys and your cash, okay, and it will never be seized, or I mean in most cases. So that's one very big benefit. On the other hand, it's there's no customer service in crypto, right? Like if you lose your seed phrase, you really are screwed. There's an Israeli company called Zengo, which offers a biometric wallet where you don't have to have the seed phrase. It works on a technology called MPC, and it's like a wonderful user experience, but you still need to understand what you're doing. You could easily send crypto to the wrong wallet address, to the wrong smart contract, and then it will just get swallowed up forever. True story. My son has recently got into Polymarket, which is like you could bet on sports stuff with crypto or whatever. And he asked me if I could send some crypto to his Polymarket wallet, and I sent USDC, which is a stable coin that's tied to the US dollar, to a USDT wallet address, a smart contract, and it's just lost forever. So those are the kind of things that you might want to save yourself from, and you could do that by staying in the ETF world. But you're losing out on things as well. And I think in the end of the day, these are technologies that will be prevalent in our lives in the future. Whether or not Bitcoin will be, I don't know, but these technologies I think definitely will be. And it's important to get accustomed with them, and getting scammed and messing things up are kind of like rites of passage to learning any new technology or skill. So I would encourage people not to be deterred, even if it's like small amounts, like a few dollars here and there, just to get familiar with these products. I would highly encourage people to dabble in them. And then I think the biggest benefit to holding crypto directly and not on as an ETF is that crypto never sleeps. Markets are open 24/7, literally. And it's always fun to watch the price of Bitcoin shift when markets open in the States, and then all the traditional investors come in and start trading. And then when they go to sleep, when the markets close, and then everybody in the crypto ecosystem continues to trade, news that affects crypto continues to come out all the time, but the market won't be affected until it opens tomorrow. So you're missing out on the crypto never sleeps aspect, and probably on most of the biggest wins.
I'll also add I'll
At the
just add
same,
in to
yeah,
that for someone who's a long-term investor, one of the things they have to be careful with is trading. So it's a very different approach to buy Bitcoin to have X% holding within your portfolio and to hold it for the long term because it's an asset class that may grow significantly in value, to trying to catch the ups and downs of the market, and whether you're doing technical analysis or responding to news cycles or whatever it is. And it's very difficult to be able to time the market and to win when you're looking at short-term price movements.
absolutely. Okay, another question I wanted to ask you, and this is something that I've been struggling with, is dollar cost averaging, DCA versus bulk buying. Okay, so there's this concept, and I've often, whenever I wanted to gain more exposure to Bitcoin, other assets, like asked on some of the crypto groups that I'm on, like when should I buy or how much should I buy? And people generally say DCA, right? Dollar cost average, basically like buy the same amount every week on the same day over time, and that generally pans out better than just like buying whatever $10,000 today when the price is X. I would love to understand the rationale behind that. I don't think it's a crypto specific question, but I think we have a mutual friend. I don't know, just at least based on your commenting on his post recently, Ari Gore, who's taken on this experiment where he buys once a week $50 of Bitcoin, $50 of Ethereum, and $50 of S&P 500, and kind of just tracking their performance over time. But that's like a DCA move. And when I suggested recently to a family member of mine who wanted to gain Bitcoin exposure to buy once a week throughout the year, he said to me, "Why? Like Bitcoin went down to 98,000. Why shouldn't I just buy it all once?" So I don't know what the actual answer is. I'd be curious to hear from you, Nadav.
Yeah. So it's a great question. I mean, when we have a look mathematically over time at what is more optimal, it
Mm-hmm.
depends on what we expect the market to do over the long term. So if we look at the S&P 500, we've traditionally seen it go up. And if we expect it to continue to go up, regardless of the short-term price movements, but we expect that over the next 20 years that it's going to go up significantly in value. And in any one particular year, it goes up 75, like there's 75% of years the market goes up rather than goes down. When you look at the analysis, putting your money in as a lump sum usually turns out better than dollar cost averaging, which is a surprise to many because dollar cost averaging is the thing that everybody talks about. And the reason why that's the case is because when you have a look at the period of time between if you were dollar cost averaging when you'd first put it in and when you'd put the last dollar in, there's maybe a year in between or some period of time in between when the rest of the money is sitting in the bank. And when we compare money sitting in the bank to money invested in a market that goes up a lot more than it goes down, being in the market allows you to capture those gains. Where is, and we'll talk about crypto maybe in a second, although I don't know if I have a huge amount to add that is different to the traditional markets. Where is dollar cost averaging very valuable? It's when you don't have all the money up front. So let's say you're saving $1,000 a month and you're buying every single month. So you're taking advantage of, you're essentially averaging your price over time. And more importantly, you're getting your money into the market as soon as possible. Now, putting a lump sum into the market at once can be a scary thing because even though more often than not it will benefit you, it could be the case that you're buying right before a huge dip. And if you would have waited and put in maybe 25% today and 25% tomorrow and 25% the day after, then at least if there's a dip, you say, okay, I've put in a little bit of money. So psychologically it helps. And if the market goes up, you can say, great, I've got a little bit of money left to put in. So generally, we say with the market that psychologically dollar cost averaging is better. Here we're talking about a situation where you've got a lump sum. Dollar cost averaging is much easier psychologically, but we don't want to spread out over too long a time because then you've got the money just sitting in the bank doing nothing. Whereas lump sum investing does better than dollar cost averaging more than not. When it comes to Bitcoin, assuming that we're investing because we believe that over the next 10 years it's going to go up significantly in value, we have to ask ourselves across the period of time that we're going to be dollar cost averaging, what's the probability that it'll go up more than it'll go down? And that's a very difficult question to answer without a lot of historical data.
All right. Thank you very much, Nadav. That was very helpful. Some parting words to our current or future crypto speculative investors.
I think that if you're sitting down to assess your assets, it's really important that you put a plan in place that you write down, whether or not it's 30% in Bitcoin or it's 50% across a range of different crypto assets. Thinking through why you're doing that and then writing it down for yourself allows you to stick to that plan over time. Because one of the worst things that I see is that people who bought a little bit of crypto did incredibly well, and you have a look at their whole portfolio, and suddenly they have 60% in a range of crypto assets, but actually they would feel much more comfortable with maybe 10%. And so when you set for yourself target allocation and then you're able to assess that over time, and if crypto does triple over the next 2 years, then to sell, to bring debt, to take those earnings and to bring the allocation down to something that you're comfortable with is really important. And that's
That
important across all asset classes, no
Right, I
matter
was
what
going
you're
to say
doing.
that's important, but you also just touched on another thing that I think is also really important. Taking profits. That's something that's really hard to do, right? Most people that I know, at least in the crypto industry, are playing a long-term game, and it's very hard to make the decision. Let's say you bought crypto. Let's say you bought Bitcoin at $30,000 and it went up to 100. Do you sell? Like
Well, I
most people
think
would double down and say, all right, like if I made it to 100, I could have easily sold at 50 or at 60, or after it hit 69 the first time, it went down to 19 and I kept totaling, and now I'm at 100. Like, so how do you make it, when is it the right time to take profits, and how do you if you're a long-term hodler and you've made it through various like very brutal ups and downs, how do you resonate with that?
yeah. Firstly, this is an age old question, and it's always been the case that when people invest in an asset that goes up hugely in value, they usually try to double down on it. And that's one of the reasons why a lot of active investors lose out. And what I just described before is called rebalancing. It's saying
Hmm.
that I've got a target allocation and I'm going to make sure that I stick to it. And the wonderful thing about rebalancing is that it forces you to sell the thing that went up and to buy the thing that went down. And when we're investing in solid long term assets, the research has shown consistently that that activity of selling the thing that went up and buying the thing that went down is often what allows you to capture the growth of the market and to not make major mistakes. And so I
I think
think
it is important.
understanding that
No, I was,
research
I was
and,
just
and
going to say it. Go ahead.
go on.
I was just going to say that I think it's important, since we're likely speaking to a lot of Israelis, to note that under Israeli tax laws, when you sell for profit, you need to pay mas revachon, appreciation tax, on the amount that on your capital gains. And then when it goes back down and you buy again, and then it goes back up again, and then you sell again, you have to pay those capital gains. It makes it easier to hodl because of the way things are taxed here in Israel. Like, just by virtue of having put those profits back into your portfolio and rebought the same asset, you don't escape the tax. You still have to pay the capital gains on the sale. So again, that's something that you need to take into consideration as well. Because sometimes it doesn't. If the margins are small, it makes it almost not worthwhile to sell the first time.
Especially with crypto reporting, which is relatively complex in crypto tax reporting, which is somewhat complex in Israel. But in saying all of that, we should generally have tax as secondary consideration and risk and allocation and goals as primary consideration.
Okay, that was helpful. I find myself to be swayed by the tax aspect, but I'll put it aside and keep that note for the future. Nadav, thank you so much. For people who are not familiar and want to find out more about Blue and White Finance, how can they get in touch with you? How can they gain access to your courses? I know I saw social media posts, I think yesterday or 2 days ago, that you guys revamped your whole platform and you got all techie now with an app. Tell us very briefly about that.
Yeah, sure. So, firstly, anyone that wants to find out more about what we do, you can go to bluewhitefinance.com and you can find everything there. I think our best resource there is all of our free content. We publish about once a month a free guide on a range of financial topics. It's all in English and designed primarily for Olim or English speakers in Israel to understand how to begin investing, how to understand tax changes, how to handle maternity leave and credit cards and opening accounts and reducing fees, all sorts of different things. And then in terms of the active work that we do with our clients and students, we have our guided investment program to teach you how to begin investing and to handle the cross-border taxation, which can be really complicated when you have foreign citizenship, especially American citizenship. And we also do one-on-one financial planning with clients, as we did with yourself, Yitzy.
I would say the free content is great, but definitely don't stop there. You should take it a step further and definitely get your hands dirty with Nadav's courses. They're really, really phenomenal. And I'm not getting paid to say this, just from firsthand experience. So Nadav, thank you so much for coming on and dispensing your knowledge with us today. And I look forward to continuing to read and enjoy your content.
Thank you. It was a great pleasure. Thanks for having me.
Thanks, man. Are we recording? Okay. Nadav and I just finished the episode and we were schmoozing, and I proposed like a potential hypothetical apocalyptic scenario, and Nadav actually said that you should all buy Bitcoin in the event that the entire traditional financial banking ecosystem collapses on its head, and that causes governments and tech companies and manufacturers to go all bankrupt. The only way you'll be able to survive is if you have crypto. So for a rainy day, just in case the entire world goes to shit, it may be recommendable to have some crypto, maybe more than 10% even, in your portfolio. Nadav, could you just chime in and say that everything I said is true?
Maybe some of what you said is true.
Ooh, you know what? I'll take that. I'll take that.
The question is what the chance of the world going to shit is.
You know what? At any odds, like it could happen. Okay. I mean, we had COVID. We had, we're on the cusp of having World War III. Like anything could happen.
Even when we have World War III, doesn't mean that all of our systems collapse.
If there's World War III and the bank run and Y2K, Y2K wouldn't help you. It's possible that all you'll be left with is between 5 to 10% of what you currently have. So consider expanding your portfolio to slightly more than 10% for that rainy day apocalyptic scenario. Again, not financial advice, not legal advice. Do your own research. Don't listen to anything that I said. But thank you again, Nadav.
Thanks, Yitzy.
Thank you for listening to Beyond the Code. If you enjoyed this episode, make sure to subscribe, share with your friends, and to tune in again next week for more fun and insightful conversation.